Here we're going to look at 216, guys. And I just want to talk to you about this problem just a little bit. You come out of principles, and all of a sudden you're in a master's level class, and you just hit this problem. It's got a lot of information in it, and good. My gosh, we're liquidating a business. In other words, here's a balance sheet, and we're fixing to close down. And so, what do we do then? Kind of thing. But what this problem does is so good is that it shows you kind of some theory and concept related to accounting that is just so fundamental. So it's a great problem. Let's walk ourselves through the solution, and let you guys kind of understand where they're coming from here. Just remember that if you have um, receivables, like accounts receivable, it's just money that people owe you. And if you're to the point where you're fixing to liquidate, there's probably a pretty good chance that you may not get all of those receivables, right? So, hey, you have X amount of accounts receivable, like $90,000 worth, and you kind of expect that you'll be able to collect, even on liquidation, probably 80% of that. But here's the thing, about 20% of that, look, you're not going to be able to collect, okay? So I want you to look at this first column here and just follow my cursor just a little bit. This first column is what you would get for these assets if you actually liquidated. And then this column over here shows you either a loss or a gain associated with that liquidation. So look at here, we have receivables. So we're only going to collect 80%. So over here we have a loss of 20%. Okay? And if you calculate that out, 90,000 times 80%, that's 72. 90,000 times 20% is then 18,000 loss. And then you come over here and we have merchandise inventory. Well, our inventories, we think, inventory a lot of times, by the way, when we're liquidating, we don't think we're going to get as much money for it, most certainly as we bought it for. So, merchandise inventory is very often just recorded at cost, and we just don't think we're going to reap that by reselling that inventory right now. So merchandise inventory, then it says that we're only going to collect 70%, and that means 30%, of course, is a loss over on this side. And then, of course, we here in the buildings and equipment, I want you to look at these numbers carefully, because if you look at the balance sheet, you'll see that they don't really have a number for book value, at least listed on the balance sheet. So you have to come up with book value yourself, and they give you that the buildings are 400,000, and that the and equipment added with it is 400,000, and then you have an accumulated depreciation amount of 120. So really our net book value of our buildings and equipment is 280,000. And then what we did was we added 60,000 to that to get this to 340 here. And so the amount that we think we're going to get above our buildings and equipment that is recorded at a certain amount, the amount we're going to get above what is recorded, then is going to be a gain for us of 60,000. Okay. And they basically give you that information, but you just got to add it to and kind of figure out what book value is on that non-current asset there, buildings and equipment. And then we have land, and the appraised amount looks like 85,000 is something we can get for that land. And of course, we may have the land, we may have bought it some time ago, and it may be listed here, and it is listed for 50,000. So we would have a net gain if we liquidated this land. Now, if we sold this land, we think we could make a gain of about 35,000 on it. So here, if you did liquidate, you see you get a total cash received of 602, okay, and then you get net gain of 32. So very clearly, when we liquidate, we're going to have what we refer to as a net gain. And that's only simply because the gains that you're going to receive when you liquidate are higher than the losses. And then, of course, we're going to get a certain amount of cash. So if you'll do this and just kind of go to the next part of this particular problem, and you'll see I kind of brought down the cash of 602 here and the gain of 32,000. And if you take this very important idea of how do we handle the cash? Okay? How much cash do we have and what do we owe is really simply the question. So here you'll see that we have $632,000 in cash. Now, a lot of students miss this. They go, well, why? This is 602 and this is 632. Why are they different? And the reason they're different is because your balance sheet says you already have 30,000. So if you add 30,000 to the 602, you get 632. And guys, we're just going to take what we owe, like accounts payable, note payable, wages payable, interest payable, and we're going to pay those. Now keep in mind that the wages payable, and this is so typical of businesses that are liquidating, we're going to take, we're going to have some stuff we haven't even put into the accounting system yet. Like we have payables we haven't even recorded yet. And so we know we still owe them even though they're not recorded, but we have to pay them with the cash that we have if in fact we're going to go out of business. So instead of recording all the payables, we're just going to pay them, right? We're not even going to put them in the system. But if you'll look here, you take away the accounts payable and the notes payable, wages payable, interest payable, then we got to pay that long-term debt off. And if you'll look, you'll see that we've got an amount of cash left over that are supposed to basically belong to the stockholders of the company, whoever that may be at that time, of 297. Right here, you'll see the double lines underneath, which is a final in accounting. You'll see that often. And then down here, gains and losses. And come up 280. And we're also going to adjusted stockholders' equity of 297. Well, where have we seen that number before? Well, that's the total cash. And oh gosh, guys, I just want to tell you, please, let me tell you, assets then, cash, equals equity then, right? And you don't, it's the accounting equation. You don't have any liabilities. So that means assets, cash equals equity. So the accounting equation, even at liquidation, works. And that's really the whole point of this problem, is that you understand that all of that debits and credits that we do left and right, we're actually got a balance at the end. And when we do, our assets, whatever they are, in this case just cash, is always going to equal our total equity. So if you'll look at this real quick, you'll see that if you add the unadjusted amount and the net gain, right, less those unrecorded amounts, you also get the 297. So that's the whole point to this problem, is equities then are the same as assets, even in the end, when you're putting a stake in the heart of the company here and you're shutting on down. So good point, good problem. May see something similar to this on the test, so be sure to go over these problems again and connect and understand them with pencil and paper first.